Hey everyone, welcome back. Dave, it feels like we just did this yesterday.
Wasn't it yesterday when we did it? Oh, wait, it's
No.
been a week already.
Yeah, here we are back. And what's happened in a week for you? Anything exciting?
Not too much. So busy working that I haven't had a chance to do a whole lot outside of the office.
It seems like the work is just coming in. It just seems like besides tax and planning, it just seems like everybody I turn around is reaching out to you for something.
Yeah, they definitely are, and it's a good thing. Always happy to help people, but it is a little crazy right now. I will admit. I was talking to our staff yesterday, and I don't think I've been this busy in maybe a decade or more. It's been that crazy. It's something that I did in the early years of my career, and I'm not against being back there now so we can help as many people as possible, but definitely hoping we don't have to keep this pace for another decade or so.
Yeah, definitely things in the world have changed. And so it's been interesting to learn the process and learn how we can juggle everything. But Dave, we're talking specifically retirement today. And one of the things that we need to make sure that as tax rates change, right? I mean, we're proposing that something like that may happen down the road and why it's important that people need to take action today.
We definitely are, but there are so many things in our future that are going to be different than they are currently, and it's really our job to help get people ready for that period of time. Now, we don't have a crystal ball. There's nothing that I have different than what you have beyond my own knowledge and research. But as we look at the trends, as we look at history, as we look at all the things that are going on around us, definitely see some concerns and some opportunities to take care of those concerns as people prepare for the retirement.
And we want to welcome those who are joining us live, also those on replay. And if you're joining us live, go ahead and say hello, tell us where you are. And Dave, I want to mention that Gary's on already bright and early this morning.
Gary, good morning. Saw you this morning. Sorry I didn't get a chance to reach out this morning on the webinar on reverse mortgage. I had a webinar this morning. Gary was there. Always glad to have you with us to participate, and the questions you ask. Always happy to try to help in the things that you're doing and your work with what you
Yeah,
have going on.
Gary always has amazing questions. I mean, I've gone through like hundreds of his questions, and I think he's has so many great questions. And so we encourage you out there, if you have your questions on retirement, like you said, you even taught a class on reverse mortgage, if it's on Medicare, long-term care, Social Security. Dave, I feel like we just get every type of question that we throw at you, and that's why we're here, so we can throw more questions at you and help everyone watching to figure out how they can live the best retirement years.
Yeah, pretty soon it's going to be the CR show. We have so much going on the backside with new webinars, all the updated content. Obviously, as you go through all these questions all the time, you're going to get to a point that it's just going to be you able to take this over, which is great, right? As we try to help people.
Yeah, well, let's focus on you today and let's see if we can take it from there. So if you're ready, Dave, I want to jump into a few questions, and I want to point out what Gary's saying here first before we get started. He said, no matter how many times I listen to you, Dave, I always learn something more.
Thank you, Gary. I appreciate that. That definitely is my goal, to help people better understand the concepts that we go through. And there is a lot of information. I mean, I will say we're hitting our 52nd podcast for this season. You may know that, CR, because you add it and you go through that. But we're a year. We've hit a year on these topics, and we're still coming forward with new information. And we've done 13 to 20 webinars. I don't know what we're up to now when you take all the revisions and everything we've done. But there are hours and hours and hours of content. And yet I learn something new all the time, too, as I continue to get people's questions, study, research, try to better understand the concepts we go through.
And I'm on the same page. I love this because the more we're doing this, the more we're involved, the more we learn, but then we also get updated. So we're not just learning the facts that were here 10, 20 years ago, but we're actually staying abreast of everything that's new and things we need to focus on. So that's why we're here today. And Dave, my first couple questions I have, they're two different sides of the spectrum. So I want to start with our high here. And this one is Andrew. Andrew says, I have 5 million in an IRA. Can I transfer it to a life insurance retirement plan and thus eliminate tax on future distributions?
Andrew, let me answer this question in multiple parts as we look at what you've got here. When you look at the life insurance retirement plan, the goal of it is to build a tax-free and future tax-free growth, tax-free distribution investment that can help you with a long-term care event. It can help you eliminate some of the market risk. When you're looking at the amount of money you've got there, $5 million, that's probably going to be way over the amount that you would be able to put into this type of investment. Now, there are going to be some limits. You may choose to put millions of that in. Again, people do different things, and they have different plans. That would be something we would want to look at for sure. Now, that being said, that conversion is going to require you to pay tax on the conversion. So you're not going to be able to just transfer it over and not pay tax. You would have especially if you did it in 1 year, I mean, you're going to have a multi-million-dollar tax bill. So as you look at your question, yes, there are some things that can be done. Is it as simple as saying, yes, let's do it today and transfer it all over and try to get our money in a tax-free, risk-free investment? No, unfortunately, it's not going to be anywhere near that simple when you've got that kind of money sitting in this type of an account.
And Dave, so you kind of alluded to it, but is there harm in having 5 million in one bucket that you're talking about?
But there's a couple of issues that you have there. Yes. I mean, one from a tax side is you're in partner with the federal government and you have no idea what they're going to take out of that investment in the future. Now, we know what rates are today. We know what rates are going to go to in 2026. But when we look to the future, they, with a stroke of a pen, can come in and say, we want 50% of this rather than what we currently have. Other issue we have with IRAs that people need to look at now at $5 million, they're not currently over the estate caps, but there may be a point that you get over there. If you've got to pay estate tax on that money and then income tax on the transfer at death, it's a problem. I mean, most people with money in these type of assets going into the late end of the retirement years, it can create some major tax issues for future generations. So a lot of discussion that what I'd want to have with Andrew as we went through here. I think there's some opportunities to move buckets to get into a better position, but it's not going to be a one-step process by any means.
Now, Dave, I want to go to the other side, and this is where we're coming up to Britt's question. And Britt is like, I have no income. Can I still convert money to a Roth? And so we're kind of looking at two sides here.
I'm assuming in this situation that Britt's got some type of retirement assets that are sitting out there that are in the wrong bucket for their situation. Maybe got a large IRA that's been sitting out there for years and they're wanting to get the money over. A lot of that's going to depend on your age. Britt, if you're under age 59 and a half, where you'd be subject to the penalties, we could look at doing something like a 72T that would allow you to take part of the money out of the account and be able to pay those taxes. If you're over age 59 and a half, you wouldn't be subject to the penalty. So we could do conversions and then just take money out of the transfer over. So could be done, but we would want to better understand your facts and circumstances and how they may fit into the recommendations we're talking about.
Now, Dave, my next one I have from Richard is he's asking, can the owner of the shares of an NYC co-op use the equity to apply for a reverse mortgage?
Generally not. When you look at co-ops, they're usually exempt out of the reverse mortgage option. Usually what you've got to have is a home that you own yourself. Now you can own anything that's up to a fourplex. So if you had a fourplex and you were living in one of the properties, you would be able to put a reverse mortgage on that property. But co-ops are usually exempt. You would want to talk to a reverse mortgage company just to confirm. But I don't think, Richard, you're going to be able to get any reverse mortgage funds off of the situation you're in there currently.
And Dave, since we're talking about reverse mortgage, I wanted to jump over because Gary has a question already, and he's asking, regarding the subject of reverse mortgages, how much time is the mortgage holder or homeowner allowed to repay the loan after he or she is disqualified because of a long-term care event like moving into a nursing care facility?
Gary, usually you've got 6 months to try to solve this issue. Once that it's been identified and the mortgage company is aware of what's going on, usually you've got 6 months to solve that. Now, there are situations where they can extend that out. Maybe you're in an area where the housing market's such that you're not going to be able to dump that home in a 6-month period of time. And the mortgage company realizes you're working with them, trying to get the home sold. You're doing your part. So they may extend that period out to allow for the market to get you there now. And I don't know anywhere in America right now that homes aren't selling like hotcakes. So when we look at it today, not such an issue, but there are options if you're willing to work with a mortgage company where they can extend those dates out if they're extenuating circumstances or causing the problem for you getting that transaction done within a 6-month period of time.
Dave, I thought everyone was moving out of California so they could buy a home anywhere, but my sister is moving out of California. She just recently moved, and she said that even her home out there, she's having bidding wars. So it's amazing. Like you said, anywhere in the US right now, I feel like their homes are hard to get right now.
It really is, and part of it doesn't make any sense because even in the area that you live in, there in Utah, is definitely getting a lot of people moving from California. In fact, I've talked to rental com rental truck companies and those type of businesses talking about what they're going through, trying to get people relocated into Nevada and Utah. But you're right. There's definitely people coming in, whether it's people from other countries or locals that are just haven't owned a home for a while. Those California properties are selling out as quickly as they're being put on the market as well. So it is a crazy time. Personally, I'm very concerned about it. I think the market, what's going on now, I'm seeing so much of 2008. What happened prior to the collapse there. We're seeing a stock market that makes no sense. That I personally am very careful right now with my investments and what I'm doing. But each person has their own opportunities to take their lives and do with it what they please. But I definitely am a big fan right now of trying to protect that principle and get yourself in a position so if things change, you can be in a position to be able to buy at that point.
And great advice. Dave, I want to go back over and just discuss a moment from what Gary brought up, because he was talking about, and you alluded earlier that you were on the reverse mortgage webinar. And so those webinars can all be found at theprosperityguy.com. Go click on events and you can see any of the webinars that you have coming up there. But Dave, on Gary's question, he talked about having being disqualified because of long-term care. Do you have any other ideas of what could make you disqualified for getting a reverse mortgage, or if you're in a reverse mortgage and then you're going to get disqualified?
You've basically got two major issues that you've got to deal with if you already have a reverse mortgage. One, it's got to be your primary resident. So usually you can control that. If you choose to move somewhere else, you know that's going to happen. But as Gary brings up in his question there, you don't know when a long-term care event's going to happen. So that event in and of itself could force you out of the home, which then puts you in conflict with your loan agreements. So that's one situation you've got to look at. The other is you've got to ensure you're paying the costs associated with that property, that your property taxes are getting paid on time, your insurance is staying in place on the home. If there are repairs that need to be done, that those repairs are getting done in a timely manner, so you don't have an issue. Now, they have the right to come by every year or every 6 months, whatever they choose, and inspect the property from at least a drive-by going around your home. Some companies are going to do that, others aren't. So the repair side is going to vary based upon your individual situation. But again, you don't want to be in a situation where all of a sudden they're coming in and saying, look, your roof's got to be replaced. It's going to cost you 20 grand. You may not have the money to do that. And now you've got a real problem with that reverse mortgage and what you've got going on there.
Great. Well, I just wanted to get that clarified because I know a lot of people ask, well, how do you get over some of these issues? And those are things that obviously are case by case, but I appreciate that.
Yeah, and it really is one of the biggest things people have got to understand with the retirement is that all of it's case by case. When you look at it, yes, we can give you general information. Yes, we can talk about the basics, these rules that govern how we stay in the home. But when it comes to your situation, it's going to differ for all of you. You're going to have different situations you're going to need to look at.
And Dave, we talked a little bit about different subjects, but one of the ones we talked about this morning is the life insurance retirement plan. So I wanted to bring up a question from Maurice, and she's asking, how attractive is this for non-US or non-green card holders outside of the US mainland, for example, Puerto Rico or Guam?
I can talk about Puerto Rico because I lived there, and there is a major problem in Puerto Rico. Now, I don't know for Guam. I would assume some of the rules are the same there. Problem you have is that many of the products that are offered in these territories do not fit the requirements of a good life insurance retirement plan. One of the issues that we had in Puerto Rico is that you couldn't get a program or a policy that would offer a long-term care rider or a chronic illness rider. So you didn't have an option to take the death benefit early to be able to use against a long-term care event, which is problematic. The other one is it was hard to find a company that would allow you to take money out during your lifetime without having to pay substantial fees. The spread was too big to where you may be paying 1, 2, 3, maybe even 4% to borrow your own money. So you've got to be very careful if you're outside of the mainland US, and even inside the mainland US, some states have restrictions that you're going to want to go through and just make sure that in the policy that it's got the requirements that you need to be able to make that life insurance retirement plan work the way that it should.
And so, Dave, if we're in the U.S. mainland and we're here and we're looking at this, I'm going to read Beth's question and see how this relates. But when is the right time to start one of these? And is there a time when it is too late to start one of these?
Beth, the right time to start is today. I mean, the sooner you can get started, the better you are, because the sooner you get started, the younger you're going to be, and assumedly you're going to be in the best health. that you're going to have. Now, some people may be in a situation where you're just overweight and you could get yourself doing some exercise and eating less and get down to where you'd be in a healthier position. But if you've got chronic issues, they're only going to continue to get worse. So the sooner the better. That there are two situations that are going to create a period of time that are too late. Number one, once you get over age 70, pretty tough to get a low fee life insurance retirement plan, even if you're healthy. So age can push you out. And number two, if you've got chronic conditions such as myself, or I've had a kidney transplant, there's no way I'm getting a low fee life insurance retirement plan. It's just not going to happen because the probability of me living a long life is so low because of the transplant that no insurance company is going to provide that opportunity for me.
Dave, I feel like we get this question a lot. Of people are saying, when is the right time? Is it when can I start? Is it too young at 20? And I think what you're talking about is making sure that we're at least starting somewhere, because if not, we get into, like you said, our 60s or 70s, and now we're trying to hurry and cram everything into this one moment and make it work. And it often doesn't turn out that way.
No, you're exactly right. And one of the other things that it may not be at the right time for you is if you're young and you only have little amounts of money. I mean, if you're maybe a young couple and you just can't afford investing in much, but a few $1,000s, insurance may not be the right solution for you because many of these plans aren't quite as productive as the stock market itself. So in those younger years, you're wanting the growth, you're wanting the expansion. Whereas you get older, or you get to where you can diversify more. Hey, life insurance retirement plan is a great bond portion alternative. So as you get to the point where you can diversify it out, yeah, it's a great option. But there are definitely times where it's not the right answer or solution for people. And when it's not, what we do is we just look at other options and how do we use those options to solve the same risk that the life insurance retirement plan is designed to solve.
And Dave, I have a follow-up question I wanted to bring up from Gary. And he's asking if you can please elaborate on the cost of mortgage insurance premiums as an important factor in entering into reverse mortgage contract.
Gary, great question. So one of the things you need to understand about a reverse mortgage, and it's a misconception many people have. Many people believe that at some point the mortgage company is going to steal your home, that you're going to get to a point that you're going to owe them so much money that they're going to come in and just take that home out from underneath you. And that's not true. As long as you stay in compliance with the loan covenants, you can stay in the home as long as you want and until you pass away, no matter if you owe $100,000 on that mortgage or it's gotten to 400,000, which may be more than the home's worth. Well, what happens in home equity conversion mortgages and why they work so well is the government comes in and says, look, we will insure the difference for you, mortgage company. So if the value of that loan gets above the value of the house, then we're going to cover the difference. We're going to step in. But in order to do that, obviously someone's got to pay for that insurance. And that cost comes out of the person putting the reverse mortgage together. So they're going to have to pay an initial upfront insurance cost. It's based upon the value of the home. The second piece they're going to have to pay is a monthly cost. They're going to have to pay a monthly insurance premium that's getting charged and added into their interest rate on a go-forward basis to ensure that if there is an issue where there's a shortfall, that the insurance company can step in, which in this case is the federal government, steps in and then they pay that difference off. So hopefully that answers your question, Gary, but a very critical part, you can't get out of it in home equity conversion mortgage. It's one of the things you have to have in place. And it is, to some levels, fairly expensive. I mean, it's not a cheap policy because there is such a risk because of market conditions and life expectancy that the government may be liable to pay a large amount of money back to the mortgage company.
And again, Gary, I hope, like Dave said, that this answers your question. And if you have any other questions, or those watching live, if you have questions, go ahead and submit those and we'll try to squeeze those in. We've got about 10 more minutes here on this episode that we'll do today. And don't forget, we're also not only broadcasting live on Facebook, but we're on YouTube. And so that's been really fun for us. And we do get questions that will come through there as well. Dave, I do want to continue jumping down here on some of these questions. I have Cheryl, and she said, my financial plan estimates a conservative total return of about 4.5%. How do I put most funds in the tax-free bucket and get that return?
Cheryl, it's pretty easy when you're looking at a 4.5% rate of return. In fact, almost everything that we model on a conservative side with the products that we use, the recommendations we put in place are between 4.5% and 5%. So that's really where we are projecting these things out. Again, people are getting more than that in the stock market, and that's the discussion we have: how much stays in the market, how much goes into the tax-free bucket. But if you look inside there, a couple of things you need to remember. In that bucket, you're going to have multiple things. One, you can invest in the market. So, if you're used to 8% average returns in the market over your lifetime, you would still be able to get those even in the tax-free bucket, because you can leave that money in the stock market. Now, if you elect to go principal protected, we have many products right now that are returning after fees somewhere between 7 and 8%. So, when you look at the cost of the way these are structured, the protections they offer, not hard to get to that point, and surprising for many people, because you're used to being in an environment where CDs, what I call certificates of disappointment, bank accounts that are paying nothing, all of these things are giving you a less than 1% rate of return right now. Well, that's not the case based upon what's going on in the principal protected market and some of the products that are available at this time.
Dave, why do you think people are shy to go ahead and pull the trigger and use this 3 bucket system that you have?
Because it requires some upfront pain for most people in 2 ways. Number one, there's a cost of entry, and that's taxes. For most people, they're going to have to pay some tax money out. And we've been taught most of our lives that we want to pay as little tax as possible. So it's really hard for people to come to the realization that, wait, it's now in my best interest to pay taxes up front, where I've been told to defer for decades. Well, yeah, because things have changed. In fact, the other day I was on a call with a lady. It felt so bad that we showed her plan. We showed her the conversion amounts. She started crying. She actually broke down because they were so large. She's like, I just can't wrap my my mind around that I would owe hundreds of thousands of dollars, and that may be in my best interest. And it is, when we look at her situation. But the other thing is, it requires time. People have to put time to get into these buckets. It's not going to just happen. You've got to put some time in with advisors. You've got to be willing to spend time with us to help do the allocations. You've got to relook at things for multiple years to make sure everything's being done correctly. But that's the 2 biggest reasons I see that most people back out.
Yeah, I think that's great advice on that. Dave, let's jump over, and I have a few Medicare questions I wanted to ask you as well. This is from Janice. Can my spouse qualify for Medicare on my record if they are not eligible on their own record?
Janice, yes, they can. So it works just like Social Security does, that as long as a spouse has a work record of 40 quarters where they've been able to get credits, and that's based upon income during a 40, they're really 40 credits. They match up with quarters, although you can get four credits in a year, even if you have earnings in 1 month during that year. But as long as they meet those qualifications, yes, you can receive not only Medicare, but Social Security benefits on your spouse's work record.
And Dave, this one, I have a question on myself, but let's go with Catherine. If you have TRICARE for life, are the hospital costs still the same? Does TRICARE pay the deductibles?
Catherine, unfortunately, I don't know all the details of TRICARE. I'm trying to educate myself more and more on the way the program works for those of you that have been in the government, the military, and what they're offering there. But you're going to have to go to TRICARE themselves. I know they've got a website where you can submit questions, where they try to provide information to help answer your questions. But unfortunately, I don't know enough details about that program at this point to answer your question.
And that was my question. I was going to ask more about TRICARE as well, because that's something that we don't come across very often. So
yeah, we really don't. And that's part of the problem when you get these outliers where, again, you've got other government programs that are offered out there, and they do apply to a certain percentage of the population. TRICARE is one of those, but it makes it difficult for us to be able to cover all of those areas and to be experts in everything.
And Dave, this one from Marcia, she asked, how do you find a qualified advisor to choose a Medicare plan? Which is a great question.
It really is. My recommendation to you is going to be to go to medicare.gov, where you can set up an account just like you would for your Social Security account with ssa.gov. Here, if you type in your zip code, it's going to tell you the various plans in your area. Now, obviously, Medicare itself is a universal plan across the country, but it's going to talk about Medicare Advantage plans, Medigap plans. All of these things will be talked about. I would recommend you start there. Outside of there, you may talk to others who have been retired and get referrals from them. Or if you go to some of your local senior programs or nonprofit organizations, many times they can help you, because it is unfortunately more of a local decision because of the way Medicare Advantage plans work. So you are going to want to stay in your local area to get that information. But those are some recommendations. Unfortunately, there's not one great way to go get the information you need. But if you start at Medicare.gov, that'll be a great place to start and can lead you down the path to try to get those right answers that you need.
And if you want to get more information on the Medicare, also Dave does have a webinar, and it's in fact increasing to a longer webinar. You go to the prosperityguy.com, you can sign up for that event. But Dave, why are you increasing that webinar from an hour to maybe an hour and a half or 2 hours?
The biggest reason is because I'm finding that people still have a lot of questions when we're done with the 1 hour webinar, and they're questions really that everyone should know. Now, there's a couple of things when you educate, especially CPAs and EAs. I think there's a level of knowledge that everyone should know. And then there's a level of knowledge that experts are going to want to obtain to be able to help people that maybe they're counseling or guiding down the process of making these decisions. The problem that I was finding is that in an hour, we weren't able to even cover the basic information that I believed everyone needed to know to be able to make the appropriate decisions for their Medicare.
And I think it's important that we continue to provide that information. And like you said, to increase those classes, because the more information we get, the more we're able to pass along. And that makes it easier. So you're not out there on your own trying to search for every little piece, but you can come to one general location and get as much education as you can.
And that's really our goal at this point. I mean, you look at it, we got started and you've got to start somewhere. And we put information out there. And I believe we put great information out there. But as I continue to study and learn and get thousands of questions like the ones we get here today, what we realize is there are areas that we can improve on, that there's areas we can better educate on, that there are areas we can provide more information. And so it's really our goal to be able to do that for those of you who are not only here, but go to our webinar so you can get the best experience possible and gain the knowledge you need to be able to make the best choices for you and your families.
Yep, correct. Dave, I do have Jeff jumping on to say a quick hello from warm Florida, southern Florida.
Yeah, pretty soon you're going to be able to give Jeff a bad time because you'll be in like 70s and he'll be up to 90s, 95, 100, super humid. But hey, that's everyone's opinion. I don't mind the humidity, but yeah, Jeff, welcome. Glad to have you here today.
Yeah. So my day, I started in the 20s like this morning, and I'll be maybe to the 70s by 6 o'clock. So that's kind of a day hero we have all the time.
So my question is, did you get snow on Easter this year?
No, for the first time, I think I can remember that we did not have snow.
Oh, I just really hard in southern Utah that time of year because you never know what the weather's going to be like. And when you're planning family activities around a holiday, definitely can create some interesting challenges when you're hoping to go outside and have a picnic. And the next thing you realize you're in having hot chocolate by the fire.
It's the same as planting. They say, wait till after Mother's Day for us to plant. And then after that, it freezes 2 or 3 times. So we just never really know here. Well, Dave, I do have another question from Gary I wanted to squeeze in here. He said, do you think that the expected reduction of the estimate tax exemption from its current $11.7 million level to $3.5 million will spur new interest in the life insurance retirement plan and the purchase of life insurance contracts in general to pay the new estate taxes?
Yes, Gary, I do. I do believe that you're going to see a big spike in insurance sales if this ends up happening. I know I've gotten many clients that if it gets to that point, they're going to have to start dealing with these issues. And again, if we go back to that 3.5 million, we talk about that situation, and Gary's brought it up here, and think about one of the questions earlier where someone had $5 million in an IRA. If we're down to that level, they've got $1.5 million that's now subject to estate taxes, which could be 45% federal, maybe if you add state, depending on where you live. I mean, it could be up to 16% state tax that you may have to pay on there. So you're paying 50 to 60% of that value in estate taxes, and then you've never paid income tax. So now you've got to pay an income tax of maybe 37, 40%, maybe even higher, depending on what state you're in. Pretty soon you realize that IRA that you thought was worth so much money, once you pass away, it may be worth a 10th or a 20th of what it was before by the time the government gets done with it.
Dave, do you see a lot of changes as this starts to happen right now as well?
We're seeing a lot of changes. I think there's the hesitance. We all see that there's all this going on and all these recommendations. I think the majority of Americans are kind of burying their head in the sand a little bit, hoping that the changes don't happen as quickly as some appear they might. And I don't think personally that 2021, we're going to see much happen. But I do see a lot of people trying to get themselves in a position where they can prepare for the worst. And really, to some level, that's what we've got to do. Because again, even if it doesn't happen, even if things continue on the way they're doing, the planning that we do is designed to help you have a bit more safe and secure retirement. I mean, even if we end up at even, so we say, hey, taxes didn't increase, but they stayed the same, we still put you in a more secure position because now that's off the table. The money that's there is yours. You don't have to worry about your silent partner. So there are a lot of things that are being done. Now, if things change as we believe they will from tax side and estate planning, even what Gary's talking about here, these changes are going to help you substantially to be prepared for a future that's going to look much different than it does today.
And Dave, just to illustrate this, when I was in Texas in March, it was right after they had that snowstorm that even hit down to Galveston on the beach. They had snow and ice. And we stopped at a lot of the grocery stores just to see if it really was empty like it showed on the news. And sure enough, a lot of things were gone. And so I look at that same principle as we've talked about on the show in the past is about food storage. And why do we have it? Why do we set this aside? Because we know that day may come. And it was short-lived. Maybe it was only 2 or 3 weeks, but it was enough of a panic that disrupted pretty much the economy. Even that one sector really, really was hit hard and really hurt. And that's kind of why I look in retirement as well. I feel like the same thing, the same principles apply.
They definitely do. And everyone's got a different plan. Everyone's got a different model. But I'll tell you, even from our experience in Puerto Rico, when you look there, there were many things we were prepared for when Hurricane Maria hit. There were other things we weren't, because especially from a food side, we'd just given all of our food to those in Tortola who had Hurricane Irma come through. So part of it was self-imposed because we'd given a lot of stuff away. But what I found is with the things that we were prepared with and the places that we had prepared for, it made our lives so much easier because you didn't have to stress and worry about going out and being with all the other people in lines trying to wait for things. I used a lot of my time to serve people. Now, that's not everyone's goal. That's not what everyone wants to do. But I went through my neighborhood, yards that weren't being kept up. My boys and I'd go clean up their yards. Other things that were happening, we'd go out and clean or pick stuff up that needed to be done from the hurricane that had affected it. Distributing food. It allowed me to have the freedom to do what I wanted to do. And I guess when we look in retirement, maybe you don't want to serve. Maybe it's more you just want the freedom to do it yourself. But if you put the principles in place, when things go wrong, again, you have the freedom to make your own choices. You're not dependent upon the government telling you what you're going to do because they're going to take a bundle of your money in taxes. Say, fine, taxes go up. I continue to live my life the way I wanted to, and I have the freedom to do that.
Yeah, you're exactly right. Dave, well, we're out of time, and I wanted to see if there's any final words of wisdom you wanted to share before we end for today's live show.
Yes. Number one, Gary, thank you for being here today. Love your questions. Appreciate all you do to help those that you work with and the knowledge that you continue to gain and allow us to gain through your questions as we continue to study and educate ourselves. Number two, prepare yourselves. Look, nothing makes sense anymore. Financially, the markets don't make sense. The housing market does not make sense. All of the situations are going on in the food channels and the food supplies are not making sense. Prepare yourself. You have an opportunity right now to take care of it. I can't emphasize enough the importance of making your plan now so that as those things happen, you're not scrambling. Even this situation that Gary talks about. Now, maybe we don't need to put something into place if the estate values stay at where they are. But if they are going to drop, we definitely do. Well, have those conversations now. Get that on the table and figure out exactly what would need to be done and how quickly it could happen if these things change, so that you can make sure that you're ready if that stuff starts to happen.
And Dave, I want to remind all those that are watching live and those on the replay that you also have, like you mentioned, the podcast. We're coming up on 52 episodes of season 2, and they can continue to find that anywhere where they enjoy a good podcast. You have your LinkedIn retirement show that happens every week on LinkedIn. You also have all of your webinars. You have your new long-term care webinar. You've got the paychecks and playchecks that you're going to be doing with Tom Hegna coming up here shortly. So I want to remind everyone to sign up for those. We also have the Changing World of Retirement webinar that's really, really hard to get into sometimes. All of those are listed at theprosperityguy.com. You can find everything on there. And Dave, also, they have a chance to chat with you, right? I mean, I know it's busy time and things are working, but when your calendar is open, that those have questions or those people who are really interested in retirement can schedule a time to sit down and talk to you.
Yes, absolutely. And I encourage you to do so. I'm here as a resource. I want to help you. Now, I will tell you, something happened the other day, and I appreciate the trust you put in me. those of you that want me to work with you, and I hopefully will always maintain that trust. But someone sent me a document the other day. It says, Dave, we want to work with you. Here's all of our asset information. Tell us what we need to do. Now, I'd never talked to him. It's not like Gary, where he's been on the show a number of times. I know who he is. I'd never talked to this individual. As I got looking through their spreadsheet, CR, their bank account information was on there, their accounts, their passwords, the phone numbers. Please, please, please. Again, you can trust me. I'm not going to do anything with that information, but don't send a financial advisor all this information in the first email before they've even agreed to work with you, or you've been able to go through contracts or anything else. Not wise from just a personal safety standpoint. Again, thank you for the trust, but please, please, please don't make that a habit of sending this kind of information. Not a wise idea to protect yourself.
Well, Dave, we just really appreciate it. I mean, I know I'm here because I trust what you do, and that's the ability. And I know that Gary and many others that watch, we're all here because we want to have a better retirement. So thank you for your time, and thank you for coming on and answering so many of these questions.
You're welcome. Always happy to be here with you, CR, and with those that are with us. Glad to be able to share this information.
And again, thank you for being here. Remind you that Fridays you can catch the podcast. Wednesdays or Thursdays you can catch the LinkedIn Live video. And then again, we always have lots of videos on the webinars, on the CPA Academy. You can find it through our website. And we also have the Prosperity Club you can sign up for and have access to all of those webinars. And we continually add new webinars each time, and we update those as we do new slides. So again, thank you for being here. Thank you for being part of this live show on YouTube and Facebook. And we will see you guys again next week.